For those who haven't cut their losses or can't bring themselves to do so, this bear market is very frightening. However, for those who have already set their stop loss points, it doesn't matter where they trade because their stop loss is predetermined. Even if there's a massive crash, if they cut their losses, it has nothing to do with the crash. Let me tell you a few things. If you're holding stocks and these stocks are sustainable, have a basic value, are not deficit companies, consistently pay dividends, and have a large market cap, then even if you're stuck with such stocks, you can afford to invest time. Whether it's a 50% or 70% loss, these losses occur when the stock price enters a phase where Elliott waves are forming. That's when you get hit. Then you might see a 70% or 80% drop. Companies like Naver and Kakao have dropped 70% from their peak, right? Isn't that correct? In such cases, if you're thinking in terms of 1 year or 6 months, there's no solution. But if you think in terms of 10 years or 5 years, then there is a solution. Sustainable companies that are running at a loss but still pay dividends are likely to continue being sustainable, so you can invest time and consider the 50% to 70% drop as a bargain sale opportunity for value investing. However, the important thing is that people often get stuck in such situations. So whenever you start investing in stocks, whether for the medium to long term or short term, you should never enter positions where there is a divergence from the 1 year line. Beware of that. Avoid diverging from the 1 year line. It is actually much more advantageous to enter when the stock price is close to the 1 year line or below it. Also, according to Elliott wave theory, you should never enter stocks that have completed major waves 1, 2, and 3. If you get caught in such situations, even stocks like Naver and Kakao can drop by 80%. Here, a major trend has emerged, and if you get stuck here, it can result in a 70% to 80% loss. Of course, it might go back up later, but given the characteristics of companies in our country, there's also the possibility that it might not. Why? These guys are aggressively splitting companies, essentially discarding them. They just use individual investors as their personal vault. That's why there's no solution to this. Even companies like Naver, which don't split, are dropping like this. So, what's important is what I told you when you first enter the market. You should always enter around the 224-day moving average. It's okay to get stuck when you enter around the 224-day moving average during a reverse pattern. It's okay to get stuck at such times. But the area where you should never get stuck is after the third wave of Elliott wave theory has appeared. You should never enter after this point, and you shouldn't enter when there's a gap. Honestly, whether you're investing long-term or short-term, it's okay if you only invest at the third position of this pattern. If you get stuck at the third position of this pattern, it doesn't take long for it to recover. But what you guys do is enter at the fourth position after the third position of this pattern. You enter here, and then you get hit by the decline and end up losing. So if it drops below this line, it will come back up. I've been teaching this pattern for 16 years, telling you to catch it during the reverse pattern. So entering during the expansion phase of a regular pattern is not the way to go. This applies to even the best companies. Okay? Understand a few words?